All right, everybody. Welcome to the very first episode of the Mastering Commercial Real Estate podcast. I'm your host, Corey Mortensen, and I'm very excited to introduce our very first guest. He is someone that I have learned a lot from in the past. Please give a warm welcome to our guest, David Toupin. Dave, how are you doing today?
I'm doing great, man. Another day in paradise. Thanks for having me.
Yes, sir. So, Dave is a millennial commercial real estate investor with a ton of experience across a range of commercial real estate assets that he's been the general partner and operator with acquisitions and you're going to have to update me on this one, but $100 million. And Dave is also the CEO of Real Estate Lab, which is a training and software platform for commercial real estate investors. It is also a mentorship group, which I'm a part of, and I highly advise anybody that is looking to learn more about commercial real estate syndication that they join this group. But anyway, Dave, super excited to have you on today. Couldn't be more honored to have you as my first guest on the Mastering Commercial Real Estate podcast.
Yeah, man. When you told me you're starting a podcast, I was stoked for you. So happy to come on and spread some knowledge, share the love, and let's chop it up and talk about some deals.
Absolutely. So I want to start by kind of giving more background on you, who you are, where you came from, so that the guests get familiar, and then we can talk more about the nuts and bolts of commercial real estate. So, I mentioned that your acquisitions were in the range of, or in excess of $100 million. What does that number look like today? Because I know that number is probably dated, right?
Yeah, I don't know the number. I think it's probably north of 120 at this point. But I haven't counted in a little bit, but
Still,
but
that's
yeah,
that's
man,
great.
it's we've been growing. Yeah, I think I hit that about a year and a half ago, and do like 3 to 5 deals a year. So
Yeah, and you're how old for the listeners?
I'm 27.
27 with over $100 million in acquisitions. That's super inspiring. I know it's inspiring to me. And what got you into commercial real estate? Kind of bring us back to the beginning and what made you choose this path.
Yeah, well, I think I always had that bug that a lot of people have. Like I wanted to make a lot of money. I'm money motivated, right? And so, especially when you're in like college and young, you're like, how do I get out there and what's the fastest way to make the most amount of money? And you just hope that it's doing something that you love. And so, I started out doing some like investment banking during college. Worked for some firms up in Michigan, and I thought that was like the route I was going to go. Like I'm going to go, become a partner, you can make $1 million a year or more, but it takes 10 15 years to do that. I'm like, man, there must be a quicker way to do this. Heard about real estate. I had some influences in my life in real estate, extended relatives, family, friends, people that I had met along the way, some people during my internships too that I was working for had invested in real estate. And so I just kind of started looking into it. And then I read Rich Dad Poor Dad, which everybody reads. And literally when I read that book, I was 100% hooked. I, basically told myself, like, I'm going into real estate full time, 100%. This is what I'm doing. I'm saying no to everything else. And that's really what I did. I turned down a couple of 6-figure job offers right out of college, and I went straight into buying apartments. And I just started with a small building. My first deal I got under contract, I bailed on. I pulled out of during the due diligence period because it was really rough. But the second deal I got under contract was a 12 unit, and that's my first start.
Gotcha. So tell us what that structure looked like, how you set that deal up, and what it was like raising, because you syndicated that deal, right?
I did. Yep.
Yeah. So tell us about what you had to do, what you had to learn, and kind of the pitfalls of going through that first initial raise and syndication right out the gate.
Yeah, man, I did just about everything wrong because I didn't really have like a coach or a mentor or a group like, what we have nowadays. So it's really trial and error, like finding the right attorney to use. I didn't really use the right attorney. He was like a decent transactional attorney, but not really like a syndication attorney. So, or a SEC attorney. So going through that, and then failing over and over again, raising money from investors, not pitching the deal right, having no track record, all those kind of things made it very difficult. So I probably had to go through the steps a lot more than an individual might have to do nowadays or normal circumstances. You know, I had to ask 50 or 60 investors to raise $200,000, which is not a lot of money to raise. And I got 5 people to say yes. So that was tough. But you know, again, by doing that, you learn like, hey, the right way to pitch an investor is to put together a really nice pitch deck that's easy to comprehend, not sending a Dropbox link to a bunch of people and expecting them to open up all the files and look through it, right? People won't do that. So
Exactly.
you just kind of learn trial by fire, I like to call it, and you know, made it through that one and just kept snowballing from there.
Yeah, and I think that's really key with having it just be palatable to a broad audience when you're putting together a pitch deck, because I'm going through that right now. I'm doing a raise for development out in Hutto, and there is a wide range of people that I'm talking to for this. And I've got, you know, I know what it is. I know the knowledge and what I'm looking at, but you know, I've got a couple medical people, some people who are involved in other businesses. And while they understand what a real estate investment is, when it comes down to looking at a pitch deck, that can be overwhelming very easily. And so having that already squared away is a really important thing to do on the front end. And then you really got to walk it through with them personally, because you send that pitch deck out, and then what's next? You do a phone call with them, right?
100%. I was going to say the close process is not very difficult if you have a good deck to get some interest. You send it out, you figure out who's even able to and interested in investing, and then you get them on the phone, and that's where you close them. And the close is as simple as having a 30-second really solid pitch on the deal with extreme confidence that the deal is going to perform. And I guarantee you get anybody interested. Like, and it's got to be true, right? You cannot make stuff up, because obviously if you do that, you're going to sell people on a bad investment, and that's not what we do. But you know, the closing process has evolved a lot for me over time, but it's gotten, you know, it's easy to the point where if I have a good deal and you put me on the phone with somebody, within 30 seconds, I'm going to have them committed, because I know how to sell a deal now, right? There's certain talking points that you want to hit that really resonate with people, you know, like what's the story behind it? You know, one of the biggest things is the story behind buying a deal. And, you know, I don't buy any deals, or a real estate company doesn't buy any deals that are like on market, call for offers. Like I would say it's a very, very small percent of the deals we even look at. And so, you know, if I come to you, Corey, and I'm like, hey, I've got a deal, the seller's owned it for 40 years. I'm buying it at a huge discount. It's probably worth 1.5, but I'm buying it for 1.1. It's 80% occupied. I could raise the rents across the board without doing anything, $200. This thing's gonna be worth 2.5 million when we're done with it, and we're only gonna have to put a couple $100,000, right? So this is an easy double your money in 5-year play. And once it's stabilized, we should be cash flowing about 9 or 10%. Right there. Like that's it. That's a close. Like they're like, how do I sign up? Obviously that pitch has to match reality, but when it does, and you go in and you say something like that, it's a very easy close to get people on board. And at that point, you know, you're going to be like, who do I want to bring in on this deal? You know, once you get to a certain point, it's like, I don't want to just bring anybody in on this deal. Who am I going to let in on this deal?
Right. No, that's awesome. And so what would you say the biggest objection that you got and how you handled it? And I'll double that question with, when you very first got started on that very first deal, what were your objections that you were getting, and how are you handling them versus how you're handling objections now?
Yeah, I think the biggest objections at first were not as much deal related, because I would kind of sell the deal. I wasn't familiar, like my first 2 or 3 deals, I wasn't familiar enough with the actual investment structure and syndication and all that. So I get a lot of questions on like, how does it work? What is it? You know, because 5, 6 years ago, 7 years ago, almost, syndication wasn't as widely known. Right now, so many people are doing it that it's pushed out to a lot of high earners and presented to a lot of people. So a lot of people are familiar, at least, with you know, you can invest passively in real estate deals. They at least know, or their friends have talked about it. So I think that was more difficult, was actually breaking the ice at that time and teaching somebody something they never knew was possible. Once I got over that hump, it was a little easier, but I wasn't maybe the best at explaining that and breaking that down in the past. And then obviously the track record was always a huge thing. Like my hardest raise ever to date still was the 1.7 million I raised on my 96 units, my third deal. And that was excruciatingly painful. The amount of people I had to go through to raise that money. And it took me 5 months to raise $1.2 million just to get the deal closed. And I still had to keep raising for like 3 months after I closed on that deal. It was very difficult, but I didn't want to bring in a bunch of people for help. Right. So I was like, we can, you know, I can do this. So, and that, you know, that was, again, was a factor of just not being as familiar with the process and not having a huge track record, being young, you know. Actually, that one did not come up as much as you may think. That was one of the last objections, right? People would have is like, oh, you're only 22 years old, 21 years old.
Would you attribute that to, you know, how you put the deal together in terms of that presentation, like we mentioned before, and then how you spoke about the deal to these people, that you didn't get that a lot?
Yeah, I would say a lot of the relationships I made were not in person. They were referrals over the phone, referrals like over email, and then I would build relationships over the phone and then get people in on the deals. So it's funny, I had like, you know, probably at least 5 to 10 of my first, you know, 20, 30 investors like didn't realize until we met in person. They're like, wait, you're only 22 years old. They're like, what? So, you know, it just wasn't something I brought up. I'm like, it's not relevant. I know what I'm doing. I understand the model. I have the ability to, you know, see this through and make you a return on your investment. So, you know, the age doesn't matter. So I honestly did not get brought up much. I think some people overthink it and focus on it so much to the point where they word vomit and bring it up when it's just not necessary. It doesn't matter how old you are. If you're sharp enough, you can go and do it. You don't got to worry about age. Talk about age.
Exactly. Yeah, that's the thing. I mean, I got taught it was, you know, if there's something that's not deal related and they're really harping in on it, and you say, listen, everything else aside, if you took this one factor out, which really doesn't have a lot to do with the deal, would you make this investment? Just kind of get them to like focus back into it. But I want to know what, because getting referrals applies to everybody, every business, everybody's work. What did that look like for you when you were getting referred? Was it you said an email, you know, what was kind of the tone and how did that go about?
Honestly, people would refer without me really asking. They would be like, "This is cool. I just told 3 of my friends about it. 2 of them want in." You know, and it was just from me building good rapport with the ones that said yes, and then, you know, having enjoyable conversations with them and just shooting the shit. They would just refer their friends. I still, like, I have one investor to date who I think has referred me over 20 people, like a couple $1 million. And so 2 years ago, I was buying this big portfolio of deals. I actually wholesaled him some apartments for like, I think he bought them for like $1.3 million. And I knew I was giving it just because he's referred me so much business. I took like a $50,000 wholesale fee on it. He bought them. He's made over like $1.2 million on those deals to date. I'm like, hey man, that was to pay you back for all of those referrals you gave me. I've teed him up basically on a really good deal. So yeah, man, I mean, referrals are great. And, you know, you know, make the ask though. Like, hey, do you know anybody? Do you have any friends that want to come in? Who do you know that's got some money? Like, be bold, you know, people respect that.
Right. No, that's great. So I want to turn it to what you're currently doing, what you're working on, how things have changed for your investment business in the 2023 climate. You know, we're in April as this recording. So what are some of the things that you have changed in your processes, whether that be marketing, underwriting, management, things like that, that you have changed and are now looking forward to doing on your next deals?
Yeah, I've doubled down a lot harder on our asset management of our current portfolio. Way more involved. You know, I've always been involved, but now I'd say at least 2 times as involved as I was before. I just want to make sure everything really stays on track. We don't have any hiccups with the market, right? There's nothing worse than being reactive in asset management or property management. You really have to be proactive, because if stuff starts going bad, and we stop leasing units, or units aren't leasing for as high of prices as we wanted, we've got to start dropping rates. Like, to be able to stay ahead of that will help you keep a higher occupancy across the board for all your properties. Your revenue is going to be higher. Looking at all your expenses very diligently and cutting out things that aren't necessary. Like, I just replaced a cleaner up in Michigan on 3 properties that was costing, like $1,000 a month, and now we're paying $500 a month. I had my management company paying this internet and cable or internet fees on a property. I'm like, why do we don't have an office? It's a 52 unit. I'm like, why do we need a Wi-Fi there? They're like, oh, well, people don't, our workers on site don't get really good reception in the buildings. I'm like, step outside, make the call, cut the $500 a month. I don't want to pay it, right? Like, things like that. Like, seriously, like, step outside, make a call. If you're not getting good service, I'm not paying for, somebody who's only there once a week or once a month, cell service, right? It's not for the residents. So, things like that, dude. Staying on top of it. And then acquisitions wise, to kind of finish your question, I'm doing the same thing I've always done. I'm a value investor. I'm opportunistic. I'm looking for deals right now that are distressed, operators that couldn't keep up with the market and are not performing well. And I want to buy deals that are at a huge discount to market value because of that. Because we haven't seen a lot of that the last couple of years. It's been hard to find them. Now they're all coming out of the woodworks. I predict we're going to see a flood of deals hit the market in 3 to 6 months. And there's going to be a ton of inventory towards the end of this year. And there's going to be probably a 6-month window while rates are still high before they come back down, hopefully next year, where there's going to be some really good price deals. And whoever buys during that period is going to make off like a bandit.
Yeah, and do you think sellers are gonna start, marking down and becoming more realistic? Because as much of the off-market stuff that we focus on, obviously we pay attention to and look at broker deals every now and then, and the prices on those that I've seen have not budged really at all in the last 6 months. I've seen some that are becoming a little more realistic, but over the broad spectrum of them, they're still pricing them like we're in a 3-4% interest rate environment with everything else. Are you expecting sellers and broker deals to become more realistic, or do you think they're still going to hold out?
Yeah, for sure. I think you need to go to see like off-market deals. Brokers really, they understand what's going on. But if they have a client come to them and say, hey, I need to get 14 million for this deal, it's maybe only worth 12. Like, they're going to list it and put a whisper out of, 14 and try and do what their client wants. But they know that it's probably not going to sell for that. And then the sellers are going to start just getting that feedback. And that just takes time. It's a process that's going to take time for deals to get listed, people to get feedback that, hey, your property's not worth what you think it is, and price drops are happening. And it's happening right now. It's already going on. You may not see it as much, but it's happening, and it will continue to happen more this year.
Mm-hmm. And so do you see yourself partnering with some of these operators who are coming into short-term debt? Let's talk about that short-term debt advantage that's coming up with us looking at deals. You've got operators who bought something within the last couple of years with really low debt, and now come refi, they're going to be in a much higher interest rate environment. And the lenders are also tightening their belts on lending, even on well-performing assets. Do you see yourself either taking these deals over, or is the strategy to partner with the operator and, kind of save the business and take a chunk out of for you? Does that make you excited, or is that things that you're considering?
Yeah, I had one of those cross my desk recently, and to be completely honest, the liability that you'll take on by jumping into an underperforming deal, even if you're kind of be taking the reins and putting their equity on the back burner, you're bringing in some new fresh capital that comes into kind of second position behind the loan or the first position behind the loan. it's a little dicey. You know, I've been presented that opportunity a couple times in the past 3 months, and I've turned it down and said, I will buy your building. I will help you avoid a foreclosure. But I don't want to step into muddy water where I can't see what's below the surface and take that on, because you are inheriting a lot of liability. What happens if you do that and you can't turn a property around, or something goes even worse? You know, now not only are you responsible for the new equity you brought in, whether it's your own or someone else's, but you're also responsible, you know, for the equity that's already in the deal.
Right.
Uh,
Is your hesitancy more on the control of the deal, and you've got a lot of chefs in the kitchen with the, let's call them XGP, and or is it more just you don't know exactly what it is that you're getting into? Because I feel like you're very capable and you could take on, really any deal and do well
sure.
with it. Is it either or is there more things to consider?
Yeah. I literally just went through this exercise on an actual deal here in Austin not too long ago. And at the end, I just didn't want to take on the liability of what they had been doing prior. And so I just made them an offer to buy it. And didn't end up working out. I think they're going to try and refinance the deal, but yeah, I don't want to get involved on a deal where somebody else has a huge, capital stack of their own. There's multiple, they have multiple GPs. Even though I would be taking the reins, it still wasn't something that was that attractive to me. Like I don't want the responsibility of all your investors and all of the mistakes you made up to this point, and the potential liability of the current debt on it. I would rather start fresh, because I have enough other deals I've got working on, right?
Mhm.
So
No, that makes sense. So let's talk about what you are doing with your team, how you work with the team that you already have and the connections that you already have, and nurturing those relationships. So for somebody that's experienced, this may be good advice, and if you're brand new, this may be something that you haven't heard much of and are curious about. So when you're talking to lenders, legal teams, and things like that, and you're putting this team together, what are some of the things that novice and experienced investors should keep in mind, and what are some of the things that you do to have such good relationships and get such great terms on deals?
are you saying just financing wise, or
Yeah, let's start with financing.
well, I think it's always good to cast a wide net. Use a mortgage broker. Uh, I always use a mortgage broker, and then I'll go to any of my own relationships to get quotes. So if I know any local banks or national bridge lenders, I'll hit them as well. But yeah, I've got a couple really good mortgage brokers. One in particular with Berkadia that I really work with a lot. Good friend of mine, so he always works really quick, and that's kind of how I deal with the financing. So it's always have some sort of mortgage broker on your team. Preferably, if you're looking at deals with like bridge and agency, definitely make sure it's like a DUS lender, direct. I don't know if it's direct underwriting servicer. Basically, they can go straight to Fannie and Freddie. They can underwrite a loan and get a loan approved for Fannie and Freddie without having a middleman, another middleman. So that's what I would say for that. And then in terms of the rest of your team, like have a good legal counsel. You want a good attorney that you can trust, that's on the ball. Some attorneys are really slow to respond. Like I'll call my attorney at 10 p.m. on a Saturday night or a Sunday night, and he'll pick up. He'll be like, hello, what's up? Hit me. So have somebody that's like really watching your back. And legal is very important to have somebody that's quick, because we got to move fast in these deals. If I've got a deal that I've got an LOI accepted on, that does not mean you've got the deal locked down. They could change their mind at any point, decide not to sell, or decide to sell to somebody else, or decide they change their mind on the price. An LOI is obviously it is like a handshake agreement on paper, but in my mind, it doesn't even hold as much value as a handshake, because you're not doing it face to face. So have an attorney ready so that you can go and get a purchase agreement together ASAP, so you can lock up a deal. And then the rest of your team are just like, advisors, like property managers, people you can bounce questions off for a property looking at, contractors in terms of renovation costs. Until you have a substantial portfolio, you're not really going to be hiring asset managers and underwriters and transaction managers and all that kind of stuff. So
Right. So I want to focus on property managers because a lot of people would argue that is the most important hire and team for the operations side for the assets that you're owning and flipping on these value add deals. So what are some of the things that you need from a property management group when you look for somebody? Maybe you're in a new market or you're trying to find somebody else or replace the current management. What is kind of your few checklist items that you really look for when finding property management?
yeah, so I always obviously meet with the management company, the execs or whoever the higher ups are, figure out if they're really organized company, ask what softwares they use, how do they do certain processes, what's their leasing like, how do they advertise, what's their bookkeeping, how do they report to owners, can they use our operating bank account, do they use their own, like just ask a bunch of these questions, get a copy of a management contract from them. The biggest thing though, when you're actually deciding, your final decision on who's going to be your property manager, you need to sit down or have a chat with over Zoom the regional manager that is going to be taking care of the property, or if it's a smaller property, the property manager. Like that's really important. There are so many big PM companies that manage 5 to 10 to 20,000 units or more that are excellent in certain areas and terrible in others. And it all comes down to the people. Just because one management company manages 20,000 units and they're overall have a good reputation does not mean they're going to do a good job on your property, because they might have a bad regional manager. And so you either need to request a new or different regional manager that you get along with and that is experienced enough, or you need to go to a new company, because it literally all comes down to the people that are directly working on the property, not the company and how pretty their website is and how cool their marketing is. Like none of that matters. The person that's day to day checking on the property, doing a couple drive-bys a week, that is talking to tenants, that is working directly with the leasing agent or leasing units themselves, that knows the area well, that knows the contractors doing work on the property. Like that is the person that is solely responsible for the operations of your business. That's your manager. The regional manager, that is who, like, imagine if you own a franchise, you own a McDonald's. That thing is not going to run with a bunch of $9 to $15 an hour employees at the cash register, on the mic, flipping burgers, if you don't have a good manager making sure they're all doing their job efficiently well, showing up on time, and everything's running smoothly. Because you're not going to be there, right? At least me, I'm not on site every day or every week. So regional manager, number one.
Perfect. So everybody listening, if you guys aren't taking notes already, go ahead and run that one back and write that down, because that was a really great piece of advice. And so now I want to focus on the market for commercial real estate just for a little bit, and then point the direction back at you and how you operate and more about you. But what are some of the things that have changed the most in the market already this year that you have seen?
Yeah, well, I'm sure you've probably seen it too, but like we've had historically high rates, but there's still not a lot of deals on the market. So it's still hard. Like you probably noticed, right? You've been making some offers. It's hard to get anything at a reasonable price. But in terms of, kind of like what we talked about before, is that what you're asking? Like what am I seeing going on with properties being marketed, or just in general?
Yeah, because you've been investing for how long?
Six-ish years.
Yeah. So what does the commercial real estate market of today look like versus when you were first investing?
I wish I bought every single property back then. That's probably the biggest difference. There's just not a lot of people like there are today. Like everybody, because of the education and the online, like everybody wants to buy apartments and get into commercial real estate, right? It wasn't the same back then. So there's not as much competition. And prices were significantly different. Cap rates were different. You know, I don't think we had nearly as much rent growth in like when I first started either, as opposed to like the last 3 years. But that's all changing now. Like rents have, in my mind, rents have peaked in most markets. Like you're able to still obviously go and buy a property and increase rents to market rate, but that market rate has been rising at such a fast pace. And now it seems to be just like completely paused. Like most of our properties, we're still achieving our renovated rents, but we're not continuing to push that bar anymore because we're like, we just want to stay occupied, right? Because especially over a lot this past winter, it was slow in certain markets. So
So that's one of the things that you're changing in your underwriting is because it sounds like previously you were underwriting for modest rent growth and now you've maybe reversed that or walked that back.
yeah, I'm doing like maybe 0 or 1% for like the first 2 years in terms of rent growth. I'll still bump our rates to what I think is today's market rate, but I'm the carry forward on that. I'm not increasing our market rates for the first, normally 2 years, maybe 3 right now, because they might go down. We might see rents go down over the next 2 years. And then where are you at? If you projected 3 to 5% increase over the next 5 years, but the next 2 years it goes down, like you're way off on your exit. So that's the tough part. Yeah, things have definitely changed in that manner.
Right.
Yeah.
So, and you've owned and operated a range of assets. I think we've done storage, retail, multifamily, obviously. Anything else? Any specialty or any other industrial?
No industrial. I've got some land. Obviously, that's not really anything special. You just buy a piece of land and sit on it.
Yeah.
But we got some commercial, commercial retail and storage. I've got a mixed use with some apartments and some commercial under it. Other than that, the new development a little bit. I don't love new development, but I've got one that's a really cool project, so move forward on that one. But yeah, I think it's been cool. I think it's good to focus on one asset class, and that's what I did for the first probably 4 years. But after that, I'm very opportunistic. Like if I find a really good commercial deal, I'm going to take it down, right? I'm not specifically targeting them, but if one comes across my desk and this makes a lot of sense, I'll definitely be open to that. Other than the self-storage, which was an intentional change, I really wanted to get into self-storage, see kind of how that business works. And I bought two pretty solid assets right here around Austin that are doing well. Other than that, I say probably 90% I stick to multifamily just because it's what I know best.
Right. Is that your favorite so far of everything that you've done? Is still multifamily?
I love value add existing multifamily. I don't love development. I don't love all the other stuff. Like my value add multifamily is just my bread and butter because it's so, I don't want to say it's easy because it's not easy, but at this point, I know it very well. And so I can predict how a project will perform pretty accurately. And for me, that feels really good because I can confidently go and tell an investor like, yeah, this is gonna be a really good investment for you. Like it's easy for me to sell the deal, and then it's easy for me to kind of orchestrate everything from start to close. So I really enjoy doing the value add multifamily. I would love to eventually get more into some other things at a larger scale, maybe like I kind of like land subdividing. Some of those things are cool. But I want to I'd love to build a high rise one day. That's a goal of mine. But for now, I'm mainly sticking to the value add.
High rise would be cool.
Old
You gotta let
faithful.
me know. Yeah, you gotta let me know as soon as you lock down a high rise deal. That
Oh
sounds
yeah, it's
awesome.
coming. Probably in Austin. Yeah.
Yeah. Oh my gosh. Yeah, it's gotta be in Austin. Well, perfect. No, I want to go into more about you and how you operate and some of your past experiences for a few minutes and then we'll wrap up. So what would you say you are the best at and what do you think you are the worst at and you hire out and have somebody compliment?
Ooh. Well, I'll start with where I'm worst. Probably marketing. And so in my software company, one of my first hires was a 6-figure CMO and saved my life. Has been just massively helpful. I am not the guy to be working in the CRMs and building out sales processes and doing ads and all the nitty gritty type of stuff. So he is phenomenal at that. He is an amazing asset to our team, which is great. I would say I'm probably best at organizing the deal. Like I'm really good at if we find a deal that makes sense, I'm really good at pulling all the pieces together. I can get the money raised, I can get the bank loan, I can get the, everything working with the title company, due diligence, coordinating and all that, put the right contractors into place, manage the whole process, structure the deal. I love the hunt of the deal. I'm a deal junkie. So give me a good deal and I'm going to go to town and make sure we get it closed. Like that's my favorite part.
Perfect. No, that's great. So what are your goals for this year? What are you currently looking forward to right now?
Yeah, I want to buy 3 to 5. I'm looking, I've got on my board right in front of me. I want to buy 3 to 5 new properties. Already closed on one last month. So 2 to 4 more. 300 software users for our software company. I think we're currently around like 80. So if we can get another 200 or so, I would be ecstatic. That'd be phenomenal. One of my yearly goals is always travel to new countries. So I'm working on that, hopefully for the summer and in the fall. And then I want to be able to dunk on a 10-foot rim. That's one of my things I'm working towards. I'm very gotten very fitness focused in the last year, which is something I hadn't been for the first several years of, working, because I've just been so focused on just grinding and making money and building the businesses that I kind of left health and fitness behind. And now for the past year, I've been extremely consistent with it, which is great. So yeah, focusing on that. And then obviously just always fostering new relationships. I love my company and my team that we've built. A lot of really cool people. Couldn't do without them. So just continuing to grow that.
Yeah, and that's a perfect segue to my next question, which is, and what is your mindset like? Like what is your approach to, because you're taking on a lot of projects, and you're, very young and, relative for everything that you're doing, and it's very inspiring. And obviously there were a lot of tough times and, maybe some doubts at times. So what is your, how would you describe your mindset to be able to handle all this and where you're at today?
Yeah, I say the biggest thing is just having confidence. Like if you can go into anything with just excitement and confidence, I think you can really tackle anything. But I'm just a really like steady. I've got a really steady mindset. Like you're never gonna see me like on top of the world, super excited, like oh we closing this deal. But you're also never gonna see me like depressed, like oh things aren't going right. I haven't closed the deal in a couple months. Like I think I've mastered the art of really staying steady, and it helps me grow quite a bit because I avoid those overexciting times where you get a little too comfortable, and I avoid the depressing times when you're like, oh, nothing's working out. So I
Do you
stay right
have
in the middle.
techniques?
What techniques?
Yeah,
I
do you have
think
techniques for that, for being
that is,
stable and keeping that mindset? Because I know that's
that is
tough.
yeah, that is itself. That is the technique. The technique is when something goes really well, don't let yourself get too high. The higher the highs, the lower the lows. That's always how it works. The higher you let yourself get, oh, I just got an LOI accepted. Everything's great. Oh, life's amazing. And then you rest on your laurels. And then next week, the seller decides not to sell it to you and you don't have the deal. And now you're depressed because you just got punched in the face. Well, in my mind, the deal could fall through today. The deal could fall through tomorrow. Until I get a contract, the deal's not closed. Like the deal's not sealed in my mind. So I'm not happy yet. Even once the deal's under contract, I'm not happy yet. I'm not excited because I haven't closed on it yet. So I still got to raise the money, put the deal together, get my own funds together, closing the deal. Even when we close on the deal, I'm not happy yet because I haven't returned my investors their money and their returns, their profits. I still got work to do. When I sell the deal and we make money, cool, I'm a little bit happy. But now I have one less asset that's paying me cash flow. I got to go buy more deals. So I'm always in this cycle, this mindset of like, it's never enough. I've got to do more, but I keep myself away from the highs and the lows, and you stay steady and like you just realize that business is a part of your life. There's no work life, right? They're not separate. Work is life for me. Like I am, business is a part of my identity. And I love that. And I find it really fun. So, once you mesh the two, dude, it all gets easy. You build some momentum.
Awesome. So 2 last questions. Where can people find you? And one last piece of advice to fire up everybody that's listening.
Oh yeah, let's get them going. Real Estate Jedi on Instagram is probably the easiest way. Shoot me a DM. If you want to email me, david@realestatelab.com. If you want to find more about our software platform for acquisitions and underwriting, realestatelab.com. And then get people fired up. I mean, the coolest thing in the world for me right now is sitting down and thinking about like how far I've come in the last 6-7 years. And I couldn't even imagine me being back in college, like where I'm at today. It literally, like I tried to imagine it, I tried to picture it, but I still really would not have imagined. If you told me 6-7 years ago, I'd be where I'm at today. So the thing I'm most grateful and blessed for in my life right now, business wise, right, besides family and friends and whatnot, is that my 19-20-year-old self said fuck it to everything else. I said no to everything. I want to say I moved away from all my old friends. I surrounded myself with a whole new circle of people who were doing what I wanted to be doing. And I worked 100 hours a week for like years. And if you want the massive results that you see a lot of people out there getting, you have to put in that work to do that. It's going to take, like, I didn't know what a cap rate was. I didn't know what NOI was, right? It took me time to learn all that stuff and master underwriting and raise money and get punched in the face a million times. You have to get up every single day with that as your sole mission and purpose. And if it's not, it's either just going to take you a really long time or you're never going to do it. So you decide. You want to get up and you want to make something happen, or are you just going to, stay comfy and stay where you're at?
You decide. Let's
Come on,
go.
let's go.
Well, perfect. Dave, thank you so much. It was an honor and pleasure to have you on the inaugural episode of the Mastering Commercial Real Estate podcast. Thank you so much. That was a great interview. Everybody go follow and check out Dave's stuff, Real Estate Jedi, Real Estate Lab. And until next time, I'm Corey Mortensen, and I will see you guys next time.
Boom.